Ed Yardeni of Yardeni Research thinks the Fed can take the rest of the year off. Following Friday's strong September employment report, federal fund futures markets predicts 5 or 6 rate cuts over the next 12 months. We're predicting none and done for the rest of this year. Ed Yardeni joins us now for more. Ed Yardeni, let's talk about that. Is that one jobs report enough to say they're done for the year?
I think it wasn't just the jobs report. We also had a very strong purchasing managers index for the services economy, and that's where the strength in the economy has been. Initial unemployment claims have remained very low, and so I think there have been actually quite a few numbers. As you know, the Citigroup Economic Surprise Index is positive again, and that's one of the reasons the bond yield is back up. It's a good indicator of the direction of the bond yield.
Ed, if you're right and they are done and we reprice this yield curve higher and we reduce how many interest rate cuts are priced for the next 12 months, how well does this equity market perform, in your opinion?
Well, I think it performs differently. I think we've clearly seen that this bull market has been led by the PE. The valuation multiple has gone up dramatically. Earnings have also been going up, which you wouldn't really have a bull market unless you really had earnings trending higher. And for the S&P 500 that are all-time record high, that's not the case for the SMID caps, the small and mid cap S&P 400 and 600. Their earnings have actually been flat. I think the market continues to broaden, but instead of broadening out to the Russell 2000, which would be correlated with interest rates going down, if interest rates stay here, I think it broadens out from the Magnificent Seven to the S&P 493.
Ed, something is different, though, this time for this earnings season than it was in August. In August, we were talking about the high bar that equities had to reach. This time, it's somewhere below 5% that we're expecting earnings growth for this quarter. The bar is certainly lower. What does that mean? Earnings season is about to be upon us. Can this not be the leg of the next bull market rally, whether or not rates are being cut?
Well, my preference is exactly what's happening here. I would prefer that the market goes up on earnings from here rather than on valuation. This is not a cheap market. We've got the Buffett ratio. I think it's 2.8. It's at an all-time record high. That's the price to sales ratio. The forward PE for the S&P 500 is about 22, with the Magnificent Seven selling at almost 30, and the rest of the market at 19. So, you're not getting any bargains here, but what the market I think will do is go up on earnings. And we're going to have another quarter where earnings are going to go to a record high in the third quarter.